Welcome to NGEN Markets, everyone. I hope my voice is audible to every one of you. And soon enough, we are going to be starting the session. And everyone is joining right now, so we can wait for a while. Till then, I would like to invite our MD CEO, Mr. Debabrata Majumdar, to give his welcome speech to every one of you who has joined into this session. So, Deb sir, welcome. You can.
Yeah, hi everyone. A very good afternoon, and I would, on behalf of NGEN, would wish you all a very happy new financial year. And we always would like to have your participation in terms of your feedbacks, so that we continue in giving the best product for your advising the customers. So we are there because you are there. So we want to be always at your side, and want to grow along with the kind of feedback that you keep on giving us. So all this, we are coming up with lots of new features, new releases that are coming up. The product team, along with Aruna, who is our founder CTO, is working around the clock and giving some of the best product releases that are coming up. I hope with this kind of features coming in this year, we would be the most preferred. Already, we are the most preferred platform, but we keep on enhancing our platform in a much better way. So that's all from my side, and I hope that we'll keep on getting feedbacks from you to improve our product. And yeah, so again, I wish you all a very happy new financial year. And over to Umen for taking this session today. Thank you so much.
Thank you so much, Deep sir, for your speech. Yes, few people are joining now. So let's go ahead and we are gonna discuss today about rolling analysis. So rolling analysis is, one of the most important feature with NGEN. And after that, we are going to actually have a Q&A session with everyone. So you can ping in your questions in a chat box, or either you can, ask us the question verbally, answer them. So let's go ahead with the session. And I hope my screen is visible to everyone. So I'm just going to show my screen of NGEN Markets portal. So here you can, definitely, see my screen. So let me just share my screen with you. So please let me know if my screen is not visible, and then we can definitely go ahead. So here, as you can see the portal, here you can see individual fund analytics, as you can compare multiple funds, and you can add in multiple funds. But here we are going to talk about rolling analysis. So now how rolling analysis is going to be useful for you when you compare multiple funds, and how do we calculate rolling analysis is the main topic here. So let's say we load in a fund, we load in some this fund. So we can load this fund as of now. And first, what we are going to do is we are going to do individual fund analytics. Before going ahead with rolling analysis, I would like to tell you is that, when we look into a point-to-point analysis, we see that, when we have a position here, like let's say in a downtime, and when we invested here, and then when we exited our positions here, you can get a very pretty heavy returns. And on the contrary, if you take another position, maybe such as here, and exited here, it gives you a different negative output. So now how you're gonna show that how consistent is the fund accordingly within the range of the returns? How you're going to take the decision in a timely basis from the start to the end date? So here rolling analysis comes into picture. So let me just open the tab of rolling analysis. As of now, when you open the rolling analysis, this is an individual fund analytics. And here, if you want to open a rolling analysis, you can see this is the tab which is opened up. And here you can select different types of working days. Now, what are working days? We consider 260 as working days. We are going to explain how we consider 260 as working days. And when you see this is considered as 1 year. And you can also see that secondly, if we shift into 520, that is considered as 2 year, and the 3 years subsequently. Now what we are doing here is we are comparing three sets of scenarios. One is the 1 year, 2 year, and 3 year period. But here you can change those scenarios accordingly. So let's say we want to look for a period of 100 days. So we can just type in 100 and we can run it, and accordingly we can see the rolling return statistics for 100 days, where we have given the average volatility, highs and lows. Now the thing here is that this is changeable, and you can compare them according to the days which we have given here. So let's consider some scenario. Let's see how we calculate rolling analysis in an Excel sheet. So this is our use case, and then we can compare it with our system, that how the calculations are happening, so that you can get a clear picture that how transparent engine is while giving the price series, and how transparent when we calculate. So here let's download this price series. So all you have to do to calculate those price series is to click here. Once you have clicked here, one Excel CSV file will be generated, and then you can definitely view that Excel. So I hope my Excel is viewable to everyone. If not, please write me in the chat box if it is viewable and or not. Let's go ahead. As you can see, these are the dates, and these are the price series, and these are the return calculated. Now how do we calculate returns? So here what we can do here is we can start calculating the return and actually mirror these things. Let's go ahead with the returns. We can just type in returns here, and all we have to do here is the first day is going to get 0% of the returns. That is self-explanatory. So we can go for a second day, and we can start calculating. So how do we calculate that? You just have to type in is equals to, and you can take the current date, divide by the previous date, -1. Now that is the first calculation. Now all we have to do here is we double click, and this is the calculation shown. And if we just show this into the percentage format, as you can see here, that is exactly the same returns which is given by engine. You can compare it with every single return, and that will be the exactly same. So now this is how we calculate the return. How do we calculate a rolling return? So let's consider a use case where we calculate a rolling return for a 20-day period. 20-day can be considered as a 1 month, but in engine we consider it as 21 days. Let's consider 20 days as of now as an average. So let's type in rolling return of 20-day period. So I hope my screen is visible to everyone, and I'm audible, so that you can possibly see this analysis. So here you can see that I've typed in rolling return for 20-day period, and here we will start our first analysis. Let's color this up so that we can see what is going on for rolling return for 20-day period. Now let's start. The first rolling return period for the 20-day would be the 22nd day, because already we are not considering this first day as it is 0% return. So all we have to do is rolling analysis just means that what we do calculations in this is that the sum of the 20-day period into the first data point. So let's go ahead. We just sum this up for the previous 20-day periods. So these are the previous 20-day periods, as you can see, and then we sum it up. Now, when you sum it up, you can see these are the 20 days, as we can directly see. The count is 20 days, and then when we just double click this, the entire 20-day periods are generated here, and we can also see visually how this rolling returns are rolling in a manner. So why this is called rolling returns? So you can just visually see that this is the first 20-day data point. The second one is this one. The third one is this one. You can go all the way down, and you can see the rolling return period for every single data point. So that's how this works out. And you can definitely see this is the rolling return period of 20-day period. Let's go for 100-day. Let's type in the 100. The same thing which we have done for 20, we can do for 100 as well. Now here, what we can do here is that we can definitely calculate 100. We can just go down, and we can see that which is that period. So as you can see, that is a 102nd period. So here we will start with the sum of the previous 100-day. That will be the first data point we will have, and we can just sum it up, and we can just select those data points. So let me just select those data points from the start. So that will be the previous 100-day period altogether. So as you can see, I'm just calculating that up. Yeah, so that is done. So once I've done the first data point, I can generate those data points in a timely manner. And you can see this is the series of data points for the 100-day rolling return period. We can just, for the color coding, we can just give it a red color. Now, these are the two rolling return period which we have generated. And now what we can do is we can actually see what is an average rolling return for the 20-day period. Before going to that section, we can visualize this. So to visualize this, all we have to do is we can just insert a graph. You can just choose in any specifics graph, and this is the graph for rolling return 20-day period is altogether. And that is all transparency. You can use this. You can even download the price series altogether from the NGEN platform and do this exercise. This exercise will actually show you that how do we calculate rolling return. So this method is actually a simple simple return method. You actually sum the daily return period for that particular rolling days you have chosen. So if you have chosen 20, then that will be the previous 20 days sum of the daily returns. Now, what we are going to do is let's compare, the rolling return period of 100. Let's make a graph of the same. So all we have to do here is we can insert the graph again, and we can, definitely show this graph like this. Let's compare them. And here is the comparison, as you can see. And in this comparison, there are lots of things we can compare. But let's compare the average, the volatility of both the period, the highs and the lows. So to compare the average volatility highs and the lows, all we have to do here is I'm just coding them as average volatility in the sense vol, the high and the low. So to calculate the average of the 20-day period, so the rolling period of 20-day, and we can also calculate for rolling period of 100-day. So this is what we are gonna be calculating all together. And then let's calculate the average for the 20-day period. So all we have to do here is we have to type in average. So that is the average. It's a simple average. You can just choose in for the 20-day period, and this is the average we have. Volatility, it's a simple standard deviation. So you just have to type in standard deviation, STDEV, and that shows us the rolling volatility altogether into this graph. Then we have the high. So for the high, all you have to do is the max, and that is the max. And for the low, so for the low, you have to just type in for min. So min of 20-day return is given here. Now here, as you can see, these are all not in percentage format. We are going to change them into percentages to show you, and we can have till 2 decimals. So these are the average volatility, high and low. We can just color code this low as red, so that you can definitely see this is the negative number. Then we have a rolling return of 100. All I'm going to do is I'm just going to copy paste it. So Excel is just going to show you the second cell, so you can definitely see this is the average of the rolling return of 100. Now you can also do it for 200 or 260, 780, all together. I'm just gonna type in this is an exercise you can do for yourself when you try how we calculate rolling return in absolute format. So yeah, so here what you can do here is that once you have done this entire average and volatility, let's compare it with our system. So I'm just gonna show you the comparisons all together here. Within this comparison, let me just show you the portal. Give me a moment here. So let's compare them all together side by side. Yeah. So once you see the comparison, you can see the rolling analysis is given here for 100, 520, and 780. First, what we have to do here is we have to change those, from 20, that is 100, and we run it. We will keep 780 as it is. Let's keep it 260 as of now, and we run this. Once we run this, you can definitely see the numbers given here. And let me just show you, let me just zoom in the numbers. The numbers of rolling return of 20-day period and the number of the average. That is how we calculate rolling return altogether. You can see they are all matching altogether. You can also try this exercise. It's a very, very intuitive exercise. This gives you an overview that how do we calculate rolling returns. And the main thing here is, we only get the data point of price series from our data provider. All the calculations, what we do is done by us. So we know whatever the calculations are done is done by us. So we have complete transparency as to how do we calculate this rolling return period. That is the one key thing what NGEN is actually transparent about, and we will always be transparent about that. Secondly, when you compare that particular rolling return period, you can see that you can do the comparison for 20 days, for 100 days, altogether for any days in this particular scenario. Now, I have done this in Excel, and I have shown you that you can do these two comparisons side by side in Excel. So why NGEN? The main purpose of here is that you can actually see, you can actually change this limit from any point of the time. You can make it 50 and run. For me to make 50 in Excel is going to be a very huge task. Now I have to make a 50 again, and again analyze the rolling for 50, and then make a graph for average volatility highs and lows. So that's why we solve your analysis issue by calculating ourselves, by automating these things. That is the one use case what we give here, is that rolling analysis. When we give, you can compare this with different multiple mutual funds, stocks, portfolios, and other securities altogether, and you do not have to worry about any rolling period or any rolling days. All you have to type in the days, and you can run in those analysis altogether. So this is the comparison of rolling return period for 20 and 100 between them. Now let's come back and let's see the graph. Let's see if our graphs are matching all together. So I'm just going to show the graph here. This is the rolling return period of 20 day. So let's just show the graph. Yeah. And here we are just going to see our graph here in the engine. Now there are two comparisons. First of all, if you want to see the graph for the rolling return period of 20 days, you can actually see they are quite identical in the manner. For rolling 20 and rolling 100 altogether. So if you want to view 400, all you have to do is to click into the 100 rolling here. So this is how this works out. And there are two ways to calculating rolling returns. One is the way which I showed you as a simple return approach. Another way is a point-to-point returns. And now for point-to-point returns, there are certain methodologies which you can use accordingly. And we will show you the methodology altogether. So let's go ahead and let's see how we can do point-to-point. Now, what we are going to do here is within point-to-point, I'm just going to type P2P here.
Can I interrupt?
Yes.
Hello. In rolling return of 20 days, you have just simply added 20 returns on an average.
Yes.
Though you definitely explain the difference between rolling return where it is given, where we are given options of absolute point-to-point and absolute.
Yes, definitely, sir. I'm explaining that as well. I'm going on to that. I'm going on to this point-to-point, the explanation between the point-to-point. So let me just explain why point-to-point and why absolute, why this simple returns what we have taken. This approach, this methodology which I have taken is an simple return approach.
Okay.
You directly take an approach of simple returns, in the methodology. Now we are going to go ahead with point-to-point, and we are going to see, how point-to-point differs from, simple returns. Now let's go ahead. First, what we are going to do is, just let me just type in here. So first, what we are going to do is we are going to start with this, and we are going to start with this price series for the 20-day period. We are going to start with this price series, and we are going to take this price series. So basically, what we are going to do is the last price series, the current price series, upon the past price series, this one minus one. Now as you can see, if I just compare, let me just see what happened. Let me just check. Oh, that is the return. Sorry. Let me take the price series. So here, the current price series here. So as you can see, this one upon the previous one here -1. Now this is a point-to-point approach. So when you compare this, when you see that's a point of 21. Yeah. So when you take that into account, you have a number of this. So here, accordingly, what it does here is that when we just type this, let me just show you. Yeah. So here, when we compare this against the rolling analysis, what we have done for the simple returns, we are just going to compare between this and this, because this is the 20. That's why I color coded to actually signify what is the difference between them. And the difference here is that when you take, let me just take into account this. Okay. Yeah. So when you take the difference between them within the percentages, you can see there is a difference in a factor, in those factors. Now, what is the difference about? So let's say we make a difference here is equals to this minus this. So as you can see, there is a difference between absolute and point-to-point altogether. So you can see the difference altogether. Definitely, we can see only the difference here between the point-to-point and between between this absolute between this simple returns, and this is the particular difference. I'm just going to highlight this to actually show you the difference. So this is the actual difference between them. Now, what is the difference? The difference here is that the compounding effect in point-to-point is actually there. In the simple return, there is no compounding effect. Now, why this matters? Because when you actually go for point-to-point, it matters when you enter the position and when you exit the position. So to explain furthermore, I'm just gonna simplify this approach because these price series are quite volatile and it's quite into a factor. Let's say we have a day 0. We had a day 0, we had a day 1, and then we had a day 2. And there we have one pseudo price series. I'm just theoretically typing in a price series of 100, 110, and 121. Now, as you all know, as you can all see, the daily return of this price series is going to be 10% for both of the scenarios. All you have to do here is you just have to calculate this upon this -1. Now the calculation here, if I just show, that is 10% altogether. If I make it in percentages, that is 10%. And if I just drop down, you can see that is a 10%. But when I go for a simple return approach, which I did, previously, which this, yellow and the red column shows the simple return, the actual, sum of those, previous return for all the days is actually going to be 20%. So how you're going to do that? All you have to do is sum of the previous days. So you can see that is 20% altogether. But let's say we go for this point-to-point analysis, P2P, and we enter our position on day 0, as you can see, and we will exit our position on day 2. What is going to be our return? So when you just see the position here, this is our first end position for today, and we enter our position here. You see the difference is 1%. Now there is a difference because there's a compounding effect, and this is why the point-to-point returns is it matters when you actually take the position on day 0 and exit the position on day 2. So only when you take the position on day 0 and exit the position on day 2, that is when you're going to get 21%. And now the market is quite volatile. You can enter any position and exit any position. and you're going to get different, varied sense of returns altogether. It will be all over the place. Even if you do the rolling analysis, it will be all over the place. Now, to simplify this approach, to make it more constant, that we use simple return. Simple return gives you unified approach, that whenever you actually invest in one particular period, that is the simple return what you're going to get in. That is a 20% simple return for the day, 0 to 2. So that's why simple return matters, because when you compare point to point, when you have 2 to 3 assets, when you have 3 multiple portfolios or 4 multiple portfolios, you cannot compare them, because they might have different price series, they might have different volatility against the market. So they might have different compounding factor altogether. But when you have a simple return approach, everything gets normalized, everything is on a constant scale. That's why the comparison between the asset gets too handy. So this point to point is more applicable when you actually want to analyze your transaction, your P&L, and your reporting. But when you want to make analysis, when you want to see historically which one has done better, which one has not done better, the simple return approach is actually appropriate. So that is how this works out. In the same manner, you can see there is a difference altogether. And altogether, even we have seen that there is a difference. If I make a difference here, you can definitely see a difference. That will be a difference of 1. So this is a 1% difference. I'm just gonna make it red. This is the difference which we have between simple return and point to point. So it depends on the, on the price series, how the differences has been. That's why point to point analysis is, more appropriate for the transaction. Whereas for simple return, you prefer, for analytics and analysis, you prefer, simple returns. NGEN prefers simple return because it gives you unified approach at any point of the time. Now, why rolling analysis matters here, let me show you that in the portal. So within that, why this matters, because let's say we have a position, we take for 260-day period. We just make it default as of now. So as you can see, this is 1 year, 2 year, 3 year period. Now, the first thing here is, why do we take this in days? The most important thing for this is that, when you consider months, the months can be anything. The number of the months can be anything for a period. If you consider working days, sometimes it is 23 days, sometimes it is 22 days, or sometimes it is 21. Now, comparing a return phase, monthly return phase of 21 days and comparing a monthly return phase of 23 days is quite not appropriate. So what we do here is that monthly is not, the monthly return scale is actually not appropriate. It varies from time to time. So either ways, the weeks are constant. So why the weeks are constant? Because we have 5 working days in a week. And if you just, multiply 5, and you can see that, 5 into, basically, if you see that, there are 52 weeks in a year. So within 52 weeks, all you can do here is that 52 into 20. So if you, multiply them. Okay, let me just type in 52 weeks multiplied by 5. Multiplied by 5. So, you will get 260. That is the 1 year period which we consider. And, if you divide this by, divide this by 12, you will get close to 21 point something as a number. So, we consider constant as 21, days in a month. Now, this is very uniform because, every single day can be different for any single point of the time. So that's why the 1 year period is chosen. So this is 260, 520, and 780. You can run this as a default. We have given this as a default. And here you can see that, definitely the average. So, what are these points? Whatever points, if we select, these points are the last sum of the 260 days returns. Whatever points do you select? You go to any point, you can say that this point is the last sum of the 260 days returns, daily returns. Now this simplifies your approach because you can understand that, if you had, Had your position before 260 days, you might have a return of negative 8.86 at this particular period. And definitely that would be the case because that is the point where the COVID crisis hit. Now you can see here as well, within the average of the entire data series which we have given is 19.74. Now if the client asks you that for a 1 year period, what is an average which I can expect from this entire data points, you have a historical data point, you can say that you can expect an average of 19.74 because this is what the average is of the entire data point for the 1 year period. This is the 1 year period which you have considered. And here you can see this is the volatility. Now here the scenario changes. When you go for a 2 year period, you have an average and your volatility increases. Now you can have your question, like if a client can ask you a question like which period is most suitable for me according to the volatility. If I go for a 3 year period, will I be getting will I be not getting any loss at all? Definitely there might be loss because crisis might hit any point of the time after this COVID scenario. There might be more crisis coming in for the next 100 years. But the main thing here is what expectancy a client can have from this historical data point. That is what you can tell your client, that for a 2 year period the volatility was quite high, and then the volatility decreased again. You can see that is 21.63. That is the volatility. And the highest you have gone for the 3 year period, it is 105.36, and the lowest is 13.83. So now you are not going into the negatives here. If you are investing for this particular asset, either it can be a portfolio, either it can be a fund, doesn't matter. When you run rolling analysis on those portfolios and asset, you can see the positives. If you see any positive, it just means that for this period, for the 780 period, it has not gone into the negative format. And here you can definitely see that it has definitely not gone. If I show you for 780, you can see there is no negative here altogether for a 780-day period. For a simple return, added them into a 780 days, this all data points will suggest you that the least you will have is 13.83 for a 3 year period, and the max you can have is 105 for a 3 year period. And this is your average. This is the average you can expect. High or low, that is the volatility of this average. So that is how this rolling return analysis works out, and that is how you can convey to your client accordingly that how you're using this rolling return analysis and how you're calculating this rolling returns altogether. Now we also have a rolling return distribution. Here you can also see the minima and maxima. You can see this is the min and this is the max, this is the max and this is the min. So for the minima and maxima, you can definitely see here that here you can have your least range. So as you can see, for a 260 period, the least is 18.02. Let's keep it as 19. So there is no no absolute in a simple written format. It has not gone less than 19%, lesser than 18% altogether. So here you can see this is the least range, and the next one is the highest range. As you can see, it's 69.06. So what we can do here is we can just type in 70. So all other returns will be 0. Now this is the range of this particular asset for a 260-day period, and between 10 to 70 is the highest distribution altogether. Now you can change this distribution. You can keep it as 5 to 15, and then you can keep this as 15 to 70. So between 15 to 70, it is definitely, you can see. So let's keep it as 25. So might be it will show you more distribution altogether. We can go for 25 to 70. So yeah, as you can see, the most percentage of the distribution is between 5 to 25. So if you are expecting between 5 to 25, definitely you will have this. This is kind of like a probability. This is the frequency of the data point of the 260-day rolling period. Let me just highlight this 260-day rolling period. That is how this works out. You can change those, these are all flexible. You can change those return ranges to see the frequency given here into the rolling return distribution. And that can be also downloadable in a chart or any other format which you want to download. The next one is a rolling volatility analysis. As we all know, one single volatility can't give us, a clear picture about the asset. What I mean by this is that when you go into the fund performance, you can see the standard deviation, which is an annual volatility of 14.79. So for 14.79, you can definitely see that, okay, this is the asset, but this is actually the volatility from between this particular, day to this day. Now, if you want to see the rolling volatility analysis for a period of 1 year, let's see the volatility for the period of 1 year. You can see the volatility, was for a last, 260-day rolling, it was actually 13.52. So underlying volatility, has shot up here in a point of COVID period. So you can see the volatility was quite high. And if you load in an asset, an asset which is older than 2008, you can definitely see some asset which is having a very high volatility, this shoot up volatility here at the point of crisis of American crisis. Basically, if you load in any fund, you can try this use case. You load in any fund old enough, 20 years old enough, you can definitely see a shot up like this, a pyramid like this, a mountain like this, which will show you that at this particular point of the time, the asset was very volatile, and this has been for a period of 1 year, and then it became down. But now it shows the volatility was never the same. What we have started with was 13.52. It was never the same. It is 15.89 as of now, as you can see. And you can see the average of this particular volatility. This is the data point for every single day. You can see those volatility for the 260 rolling wall, and this is the volatility of the volatility. So it just derives the volatility. It just shows you the how volatile is this graph. If you in a layman terms, if I tell you that what is volatility given here, how volatile is this graph? If I show the volatility of the second year period and the third year period, you can understand that for a second year period, it was more volatile. All you have to see is this. It was more volatile altogether. And in the third year, it is one of the least volatile. So if you are preferring for the least volatile period, that should definitely be 780, because that is how this graph shows according to the historical returns. And here we have given the highest, highest high of the volatility for the 260 period, the lowest, how the volatility has been for every single period. So this works out pretty well. You can choose this any asset, even for a portfolio. If you load in a portfolio from the portfolio section, you will definitely get those ideas regarding the volatility, because for a point to point basis, the volatility might change. But here you get a low rolling volatility, how the behavior of the volatility has been from the past 7 to 8 days, 7 to 8 years, accordingly what you have chosen, what period you have chosen for your asset. The period, you can choose the period from here, start date, any period. You can choose the minimum common period, or since inception accordingly, and that period will definitely start accordingly. All the analysis will start from that particular start date. So that is how this works out within rolling analysis. For absolute, it it keeps the returns as it is, and for analyzed, if you click on analyze, it will analyze the entire return sheet. So if you want to compare rolling analysis with the funds, multiple funds, all you have to do here is you have to come into the fund section. You can come into this rolling analysis here. Before going to rolling analysis, you have to add in funds. Obviously, to add in those funds, I'm loading from a comps, so from a composition. So by the way, you can save a composition and you can load in those funds all together. So once you load in those funds, you can see this is the fund list which I have given. And here I can add some more fund lists, but as of now, let's analyze just this 5 funds all together. To see the rolling for that, the comparison, we have given the average, the volatility, the highs, and the low. So accordingly, you can see the highest average is between you can see that is HDFC mid cap opportunities fund. So that is for the period of 2007 to 2022. This is the period it has started. It takes the minimum common period of an asset, which is, so you can see this is the minimum common period. So if you just click on years, you can see that HDFC mid cap opportunity is the youngest fund here. So that is the minimum common period in this fund list. And all you have to do here is you can come to rolling analysis and you can start your analysis. Now here we have given flexibility to change to any rolling window. So I have shown you how you can how rolling window works in NGEN, and why this is important, because many other platforms, they show it as a monthly or or a weekly. The problem with that is that months can consist of 23 days or 21 days, or any other days. Now if you're comparing one set of months with other set of months, how is it gonna be appropriate altogether? Because one is 23 days and other is 21 days. That's why we have kept months as it is, as 21 days altogether. So here you can see the rolling window for 1 year is 260. If you divide 260 by 12, you will definitely get 21 point something. That is the ballpark figure. When you divide 260 by, we have just rolled it down to 21, so that can be the range of the rolling window for a 1 year period. Now here we have given methodology as well. So I've discussed the methodology, both the methodology altogether within the Excel. So when you keep it absolute, when you keep returns as it is, you can change it to point, and you can change it to simple returns. The difference is slight, but you will definitely see that there is a compounding effect in point to point, whereas in simple returns there isn't. So when you run it, you can actually compare it better. So obviously you can compare it all together with an average, and here you can see that the highest average is with SDFC mid-cap opportunities. The lowest wall is by SDFC. So you can see accordingly that this one of the fund for this particular period, for the rolling window of 260, as HDFC is altogether one of the better funds according to this. But here when you change the window, let's say you go for a 3-year period, and when you run it, you can see some result altogether. And here you can see this is the result, and you can add in many funds, multiple funds. Now the thing here is that if I just want to compare Excel here, let me just show you here. Let me just show you. This is the Excel comparison. The thing here is that there are lots of ways to analyze and have the rolling analysis on Excel. I do agree that, but the thing here is that how you're gonna, this is just for one asset. This entire thing which I've shown up to you is for one asset. How you're gonna compare multiple asset by like 10, 20, 30 multiple assets, and make an average out of it, make an volatility comparison, highs and lows comparison, because it's a very drill down approach. So that's why NGEN comes into play, that this all hard work, this all analysis is done by us, and all you have to do is you have to type in those numbers to see which one is giving you the highest average expectancy and the lowest wall altogether. Similarly, what you can do here is you can also see the 780 days rolling return distribution, and within this rolling return distribution, similarly you can do for many assets. Yeah, we have seen the distribution before. We can see the highest high is actually backtested by Kotak Emerging Equity, and the lowest low is actually by L&T Midcap, which is 19.21. So we can just see here, and we can just figure it out that the highest one will be backtested directly from here. I'm just gonna type it from 10 to 120, 100, let's say 10 to 120. So to get this, let's say 125 as of now. So here, okay, the highest high. Okay, so here you can figure out accordingly with the lowest low as well, and you can see the remainder altogether for every single asset given here. Now similarly, if you actually compare this up, and if you actually see the negatives here, so negatives, you can change the negatives altogether. Let's keep it as 35. So I believe all the remainder will actually negative 35. Sorry. So when you keep that negative 35, all the remainders will be gone. So you can see from negative 35 to positive 125 is the range for all the assets altogether. Whatever I've selected here. So now you can change those intervals between them to see what are the distributions between them. So you can see that most of the assets are underlying between 10 to 25. So might be you can keep 10 here, and then you can choose multiple return distributions, multiple frequencies to see that if your client is expecting for a 1 year period, for a 3-year period, let's say this is a 3-year period, it shows here. For a 3-year period, your client is expecting between 40 to 80%. So which asset is gonna, which asset has actually done that particular distribution altogether, which asset has backtested that distribution. So that you can, definitely view into this, particular rolling return distribution. So this is all about the rolling returns. There are lots of things, which we can discuss regarding rolling returns, and we should have a Q&A session as well. So, let's wrap up this session for as of now, and we can go ahead with the Q&A session. We have Mr. Aruna Mukherjee, who is CTO of our company, to address all your questions and answers, and hopefully we can, address all of them. So please, please start shooting your questions either on chat or either with verbally. We will answer. Any questions? Please do a question.
Umer, the way you explained simple returns and point to point, can you explain how this absolute and annualized is taken into consideration along with the methodology of simple and point to point?
Yeah, hi, Arnav here. So yes, the absolute and annualized is pretty straightforward. So basically, that just means that if you define, let's say, a 2-year rolling period, the absolute will just tell you how much money was made over 2 years. Annualized will annualize that number.
Okay.
And by the way, that will happen for less than 1 year as well. So if you put a 21-day period and do annualize, it's going to annualize that 1 month period as well. So you should be, it will annualize all periods basically.
Mm-hmm.
Absolute is just as it is basically.
So ideal way of analyzing is absolute and simple returns, right?
Well, ideally speaking, yeah, if you're interested in periods, but especially for longer periods of time, you might want to look at, annualized. But generally speaking, yeah, I mean, personally, I would use absolute and simple because then I know the period I'm looking at. But some people like to use a standardized measure like an annualized return. So both options are obviously there.
See, you are giving that point to point also. Is that also point to point of the rolling returns, or it is just point to point between any just 2 point?
No, so the point to point is of the return to create the return of the rolling period. So the point to point is the methodology by which we calculate the return. So basically, Uber, just put your mouse on anywhere on the chart, on this chart. Yeah, let's see if we get, okay, fine. So there. So ICI Prudential mid-cap fund, 10th March 2008, 21-day period. So on 10th March 2008, the previous 21 days return was 6.16%.
Okay.
In this case,
that is understood. That is rolling, right?
Yes, yes.
Okay.
And as you move the mouse, it will be the other 21-day period.
No, my question is,
yeah.
For rolling returns, of course, you take the previous, if it is 20 days, then the previous 20 days.
Yes.
And it goes in the block of those 20 days.
Yes.
And then we collate all the data.
Yes.
Now, when we say point to point, this is point to point of these collated data, or it is point to point of the NAV values?
Of the NAV data, because even when we make the 20-day block.
So it is no longer a rolling yield then. Point to point is certainly not a rolling yield.
No, it's not, because it will be affected by compounding.
Right. No, the doubt is coming because it is given under the section of rolling.
Right, right. So here, the reason, sir, we actually did it is because we had quite a few questions where they were saying, I'll give you a simple example. So what happens is if you take a long period of time, especially with indices, and let's say you took a, let's say 100, 200-day period, with simple returns, what will happen is you will start to see lows which are less than 100%. So by which I mean, for example, if a price of 100 drops to 50, that's a daily return of minus 50%. Then it drops to 50, drops halves again the next day. That's another daily return of minus 50%. When you add them up, you get minus 100%. Now that's kind of impossible, what you've lost all your money. But in reality, you haven't, because your 100 became 50, then your 50 became 25. So now the thing is, with simple returns, it will report it it will give you a low of -100%. And from a perspective of explaining to a client, that becomes a problem, because how can I have -150% return? That's impossible.
Right.
But again, it's a different way of looking at it. When you're reporting performance, then it's it's not impossible at all. So that's the reason we gave this option here.
The most obvious usage that we look at it is, and that's the question that we generally get from investors also, is of course nothing can be said about future, but looking at the past data, the returns from this fund was something in this range kind of stuff. So that's just an indication for them to get a mid cap means it is around this.
Exactly.
So in this situation, the best of the most relevant option will be annualized and simple then.
Annualized and simple, or absolute and simple, depending on how you are explaining your point. Basically, some people are quite used to using annualized returns all the time. So that is personal preference really, because a lot of people like to talk about annualized returns, let's say over a 5-year period. Some people might actually want to say the number over a 5-year period. I doubled my money or tripled my money over 5 years. But what's the annualized return? So that's your choice. And if you're asking for recommendations from our side, we would say that you should use simple returns.
Okay. All right. All right. So in this multiple funds data, in the column that average, that is, in this case, it is made 21, is it? Okay, it's not 260 days, because it looks very low value.
Even if you want to make it higher, you make it annualized, but then it won't really make sense, because you're annualizing a 1-month number. So now it's big.
Right. Okay. Okay. Now this is the number we are used to seeing, right? So, okay. So if I choose, of course, if it is in this 2007 to 2020, in the block of 1 year, it is giving around 14.87 kind of stuff.
That's
what happens if I change it to annualized? It changes the number there?
It would be very, very similar or almost exactly the same. Just annualized, right?
Annualized. I annualize, yes.
Yeah, same. Because 260 in our database, 260 means 1 year anyway. So annualizing a 1-year return, you'll get the same result. But if you do 520, for example, absolute, you'll get a bigger number. Annualized, you'll get a smaller number.
Absolute will always get bigger because it gets added for 2 years. So that's okay. But I think everybody knows about annualized returns.
Yes,
they understand annualized returns.
Exactly.
Okay. So this 16.34 comes from, say, for example, 2007 to 2022, there will be lots of 520 blocks, 520 days blocks.
Yes.
So this average is simply an average of that, is it?
Average of, yes, 16.34 is the average of all the 520 blocks, 520 day blocks in this period.
Okay. All right. Okay.
On an annualized basis in this.
Annualized basis. Yeah, that's what we chose there. Okay. All right.
Perfect. Mr. Padmanabhan has a question about SIP for indices. So, sir, I don't know if we checked our, we did actually, I think, mention it on Twitter. This has been released, sir. So, Umair, can you just, so you can run SIP on index now. So, so please, have a look whenever you have time. So this we released, I believe a few days ago. So this is definitely out.
Thank you so much. I didn't notice.
No problem.
Thank you.
No problem.
So from which year onwards it's there?
Sir, from the big index data, especially for the big indices, it's actually goes back quite a lot. I mean, 2000 is there. If you want to, we can check and make it. Nifty 50 has just see. Does it go back? No. Okay, that is the first one.
Okay,
we can extend it back.
Yeah, Sensex. Can you go to Sensex if possible?
Sensex, unless this is hard coded to stop at 2000, I'm not sure. We can just see. We can I think we have data from 90s somewhere. But we again historical data. This is hard. This is a hard stop at 2000. But we have some data for the 90s also. And plus, if you want to get older data, it's very easy to find, and it's only a one-time thing to update. So that's not a problem for us. So we can we can do that.
Yeah, that would be great, if it is from 1780 when the Sensex started.
It'll be nice to see what would have happened for 40 years if you just kept putting 5,000 rupees in an index.
Correct.
Yeah.
Anirudh, hi Anirudh.
Hello, sir.
Hello, brother. My question is, what is the ideal period for rolling analysis? As investments for you are giving rolling analysis for 10 years, 15 years, year-on-year basis.
Yes,
My question is, fund manager change हो जाते हैं.
Yes, sir.
Thought process change हो जाता है for the last 3 years,
Yes, sir.
4 years. Historic data has given relevant more returns as of now.
Yeah.
So why not we take 3 or 4 year rolling analysis despite of 10 years or 15 years?
Yes, sir, we definitely can. And this is why we have given you all the options. यहाँ पे आप rolling window तो define कर ही सकते हैं. उसके साथ साथ आप पीरियड भी कर सकते हैं. ऑब्वियसली आपको ये चेक करना पड़ेगा, जैसे अगर आपका पीरियड लंबा है तो सॉरी रोलिंग विंडो अगर आपका लंबा है तो आपका स्टार्ट टू एंड डेट इतना लंबा होना चाहिए कि एटलीस्ट थोड़ा डेटा उसमें आ जाए. सो जैसे अभी उमेर ने किया है 1300 डे रोलिंग, तो इसमें आपका डेटा तभी शुरू होगा जब एटलीस्ट 1300 डेटा पॉइंट्स आए, उसके बाद स्टार्ट होगा. तो अगर यहाँ पे उमेर ने अपना स्टार्ट डेट 2007 से 1918 कर दिया तो ये चलेगा ही नहीं, क्योंकि ऑब्वियसली डेटा ही नहीं होगा. तो वो आपको उस तरह देगा, ये खाली हो गया. सो देन उसको रोलिंग विंडो छोटा करना पड़ेगा. तो यू हैव टू हैव पीरियड.
We prefer 3 to 4 years max.
Yeah, so you can easily configure this as per your requirements. आप कोई भी पीरियड डाल सकते हैं, आप रोलिंग विंडो भी आप कोई भी डाल सकते हैं.
Hi, Anirudh, Nikhil with you.
Yes, hi. I believe you had a question about US data, right? I was just is that you have? Okay. So yeah, to answer that, so yeah, go ahead. Is that
please.
Yeah, this is actually going ahead now for us. I don't know if you we did mention a few things that we are launching a new version of our product in the UK market. And in order for us to do that, we are going to be purchasing a lot of global market data. So US stocks, European stocks, and definitely at the very least UK mutual funds. This is forthcoming over the next couple of months. So you will have to wait a little bit, but I can confirm now that this will definitely happen.
Okay.
And once it comes, it will be integrated to NGEN Markets Premium, the product that is in India, and all of that data will be available here. So you will not lose out on anything, even if you're not involved in the UK product.
Okay. Another thing also, I mean, I know it could be tough, but are you also trying to inculcate PMS data onto this platform? Is it
yeah? So we have recently tried to get that done. Quite a lot of people have asked about it. Now in terms of data providers for PMS data, it's been a bit hard to find them. One option was that we actually approached the PMS houses directly and asked them for their model portfolio, the main portfolio, so that we can include it here. So we haven't had much success there, but we know that there is one platform called PMS Bazaar available, so we can try and see if we can get something from there. But this is it's just a matter of finding the data. Also, there are other issues with it. For example, I believe, I'm not sure if I'm right here, but I believe PMS companies don't publicly declare their entire holding. So I think they give you top 10 or something like that. So that might cause some problems, especially if you're going to include PMS in a portfolio. Then how do we do the asset allocation if you only have the top 10? We'll have to assume something else for the remaining part. But even if we can get the NAV, we can at least deal with the return part. And also you'll have to be aware that the NAV will be monthly. So the analysis may be a bit flawed. At this point, the people who are using our platform to analyze PMSs, what they are doing is they are looking at the latest equities that are held by the PMS, and they are uploading those stocks along with the correct percentage into the portfolio section as a stock only portfolio. And they're, they run that. And if a PMS is made up of, let's say, I don't know, 25, 30 stocks, you could easily just create a stock portfolio here and, just run the, run it just like Umair is running right now. It's a 28 stock portfolio. If you imagine this is the latest holding of a PMS, you can easily do the entire analysis here. You'll get asset allocation information as well.
Yes. So yeah, that makes sense. Actually, we can get all the analysis right here.
Yes.
Okay. Yeah. Thank you.
Sure.
Can you go back to that rolling yield section? Anyway, that was the topic for the day today. Okay, so from a physical interpretation point of view, I just want to get your view was also, if the way that I understand, let's say the first one L&T mid cap, and the data is between 2009 to 2022. So if I say to the investor, during this period, if you enter on any day and exit after 1 year, on any day to any day if you do, you are likely to see in one such year, the worst is minus 33.91%, the best is 78%. And if you held it for all these years, on an average, you would have got year-on-year 16.57%. Is that the correct interpretation?
Absolutely correct, sir. Yes.
All right. Okay. So it becomes easy for us to.
Yes, sir. Yeah, absolutely. And I think it's a pretty powerful statement to make that we don't know what's going to happen in the future. Obviously, no one does. But what we can tell you is that the worst 260-day return that's ever happened is 33.91%. It's never been worse than that, even including COVID and whatever else has happened. So, it's something that, and it's a factual statement, right? So.
Right. Okay. Yeah. All right. So that's the one. And second, my question here in this is, when we are seeing, of course, when you see an individual fund, Umar showed us that data, but you don't see that data here on volatility of this portfolio. It's not a portfolio actually; it's just a.
Oh, you mean rolling vol?
Yeah.
Yeah, that has not been included in this section yet. And to be honest, sir, the reason is that not many people, at least as maybe we are wrong, but we have seen not much interest, has come to this section from people. I believe that they should, because this is an extremely important chart. But again, it's this shows the stability of your risk basically, and that's very important, because you might be thinking I'm getting into a fund that is not that volatile. But if you look back, you say that they have actually been pretty volatile in the past. At periods, again, it's up and down between 15 and 10%. So what kind of standard deviation can I expect in the future? This at least sets some kind of expectations for it. So, but yes, we could definitely put an option there in the rolling tab in the comparison section to do volatility instead of rolling, instead of returns. That can be possible.
Okay. So maybe now what we do is that we see those returns, and based on that, if we shortlist something, then we have to come to that individual fund and then see.
You can check the rolling vol analysis there. Yes.
Right. Okay. All right. Yeah. Thank you very much.
So Aruna, within that volatility, there was 22% return over there in L&T mutual fund, the basket which we were seeing. So that 22%, what does that signify?
So, sir, that is basically the volatility of all the 260-day blocks.
Correct.
So I think from a understanding perspective of what the value is, it's a bit hard, because we know, for example, what the standard deviation of the index is, and we can compare the standard deviation of a particular mutual fund to that standard deviation of the index, or what the general Indian market standard deviation is, we know. But this is a bit hard to understand because we don't know what the 260-day rolling vol should be. But where it does become useful is in a comparison purpose like here. So here you can actually look at it. That's how you can sort, and you can see, for example, that when it comes to HDFC Mid-Cap Opportunities Fund, you in the past 260-day periods have been less volatile as compared to ICICI Prudential. So there is a bit more certainty of achieving that 18.5% average number in this case compared to the 16% number in the ICICI case, because the vol is higher. It goes up and down more than the HDFC fund.
Okay, thank you.
Do we have any more questions from anyone? Okay. I think if those are all the questions, Umair, I think we can go ahead and close up for today.
Oh, yes. Thank you so much, everyone. And, it was pleasure having you on board for this particular year, for this last year. Now we are starting our new year. So basically a financial year. So we are wishing you all the best in your advisory, and we will be there for you. We will have excellent sessions like this, every single week. And we will ensure that, these sessions will continue till perpetuity altogether. And our team is ready to give you all the sessions, and I would request more of you to come to this session, because this is very important when it comes to learning this software, and this will altogether help you out. So thank you so much, and see you soon next week on the same day, same time, Friday, 4 o'clock. Thank you.
Thank you. Thank you.